When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thanks so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about how to invest during inflation and economic uncertainty. We'll answer listener questions, and then finally the 5% diversification rule, why one stock shouldn't make or break your retirement. My name's Jeff Shea. As always, I'm just here to ask the questions with the words of wisdom and solid advice. Of course, they come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management right here in Tucson and Mesa. Hey, Jeff, how you doing today?
I'm doing great. It's always fun to be with you on the weekend.
And likewise, too, Jeff. Glad to be with you and all of our great listeners here in the greater Tucson area. As we get started today, I'll throw out the phone number 520-780-9059. I'll repeat that during the program today because many times you'll hear things in the program that pique your interest. You'd like to come in and sit down and talk with Jeff, and certainly we're offering that, the Premier Retirement Roadmap at no cost and no obligation. Once again, that number 520-780-9059, and of course we're online at premret.com. August 1st, Jeff, inflation isn't making headlines every day like it was a couple of years ago, but most retirees would tell you that they still feel it every time they buy groceries or fill up the gas tank. Has inflation eased that much, Jeff, to where it's really making a difference in people's lives?
Well, inflation hasn't eased at all. If you think about it, inflation is cumulative. It's not deflation. We haven't had deflation yet where it actually goes down, where things get cheaper. I mean, we had a moment where oil got cheaper for a minute, and now it's up high again. And then for a second, it got cheaper because they said the war was over. And then now it looks like it might get cheap again. But, you know, all that stuff trickles into higher prices. And typically when a merchant or a manufacturer, somebody gets somebody to agree on a price, they typically don't go backwards, even if the cost of doing so goes down, because they just become more profitable. Then their stock goes up and they like that. And unless there's a real competitive supply issue where there's oversupply and under demand, then people have to reduce prices. But I don't see that happening. The rich keep getting richer and keep buying more stuff and not worrying about it. We're seeing cyclical trends right now where the retail ETFs are doing better than the market is right now. The semiconductors did well for a little while, got way overvalued with all the AI hype. Now they're selling off, and now we've got retail and consumer goods, consumer staples are where all the money is. Well, part of that is because they've been able to continue to raise prices in the face of inflation continually happening. Even if it grows at 3%, that's still 3% that's going to stick around forever, and that's going to still erode investment returns. And then the catch-22 of all that is typically when inflation's a problem, the stock market does not do well. Lately, it's been propped up. It can only be propped up so long. There's a lot of margin, meaning there's a lot of printed free money that's out there that brokerage firms are just loaning people stock for a price. They're making interest on it. So the brokerage houses and the banks are making money by lending money against the stock market. Doesn't matter if it goes up or down. In fact, if it goes down, they call those loans and they end up getting to buy your stock back cheap. And they replenish their inventories of the stocks and stuff that you borrowed if the market does crash. So, yeah, we're kind of in a precarious position right now with the stock market as overvalued as it is, with the government printing money, with the debt service going from 2% or 1% or 0% in the last 10 years to in the last couple of years, every bit of debt that has to be refinanced is getting refinanced at 4 or 5 or 6. It's a lot higher interest rate, and that's going to actually increase the debt, which is increases, basically it's printing money, increases inflation. And it's kind of like a never-ending cycle. If you look at the bond market, for the last 40 years, we've been in what's called a secular bull market, meaning that the bonds prices have continued to go up as interest rates have continued to go down. Well, that ended in 2022 when Biden was in office and Yellen and Powell really saw it too late that there was inflation and raised interest rates too late. And they were chasing the problem until inflation got up over 9% year to year. I think it was in July of 2022 or 3. And then it really hasn't eased much since then. So we've got about 30 or 35% cumulative inflation since, 1.5 presidency terms ago, about the last 5 or 6 years. So everything's about a third more. So if you were living on 130,000 before, the same lifestyle is going to cost you 133. Have you made that much in the stock market? Well, honestly, If you're retired, do you have that much risk tolerance where you can risk enough to make that kind of return? Hopefully on some of your money you can. I think the key is when we look at inflation, we like to take advantage when inflation isn't happening. That's when the markets typically perform well. And that's when you ought to store a little bit of savings and grow that portfolio and not spend every dime that you make. That's when you put stuff in storage for the future, when things might get a little bit rocky, a little bit tough, and when inflation starts rearing its ugly head. Fortunately for most people, they've not seen the reality of fundamental markets and fundamental interest rates and the fundamentals behind what inflation normally happens, because we've had this kind of fake market being propped up. We've got the government just printing money at just as they feel fit. We've got crypto. That's like money printing. It's just pulling a password out of a computer and calling it money, and all of a sudden you're trading it. It's exacerbating the inflation problem. Yet it's also, with the inflation, and some of that printed money is just going into banks' hands and investors' hands, institutions' hands, and they're just investing it in the stock market, pushing it up. Oh, and they're willing to loan a lot more to investors, even the unsuspecting Main Street investor who doesn't realize what a double-edged sword buying on margin is. And that's just to give you an example. People who've listened to the show know what margin is. I talk about it a lot of times, but margin's over $1.4 trillion right now, which is, it's only been that high a couple of times, and that was in the dot-com bubble and right before the banks crashed, when everybody was just in a feeding frenzy, borrowing all kinds of money because they couldn't lose. No matter what you threw the money at, it made money. The dot-coms, if it had dot-com after, it was going to the moon. And with the banks, it didn't matter if it was real estate or housing or anything in the market. It was just going to go up, up, up until all of a sudden it didn't. And then if you borrowed, let's say you had Apple at $100 a share, and you borrowed another $100 to buy $200 worth of Apple, as long as Apple's going up, you're great. But what if Apple goes down 20%? Well, then they margin call you. So you have $200 worth of Apple, but if it goes down $20, you actually have to sell $40 worth of the stock in order to pay off your margin call. So you just basically double dipped on the loss. So margin is a double-edged sword. It cuts twice as bad going down as it helps going up. And most people don't realize it until they get stung with it. And I've been around this business 40 years and I've seen it happen. I saw it happen in 87 when I first started. I saw it happen in 2000 really bad with the dot-com bubble. Saw it happen really bad with the banking bubble in 2007 and 8. Bottomed out in 2009. Everybody's too scared to get back in the market. And then it went on a good run because the government decided, well, we'll just do what Japan and everybody else does and just start printing money and not worrying about inflation. Well, we knew the inflation bubble was going to eventually take place as long as if there's ever a squeeze in supply. And as long as supply could continue to grow and manufacturing could continue to grow, it kind of kept it at bay until COVID shut everything down. All of a sudden we had a really quick bear market. It got healed up because we pumped in $6, $7, $8 trillion. Then we put another $8 or $10 trillion in it since then, just into the hands of investors. And unfortunately, it's not the middle class investor or the person that's struggling that gets any of that money. It's institutions that don't need it. It's rich people that don't need it. It's basically the investor that already has a pretty solid foundation. And what it does is it just separates the classes. So inflation is okay if you're prepared for it. And if you take advantage of the good times in the market and you've got a little extra storage of savings and cash and investments so that if the market does correct while inflation goes up, that's kind of a double whammy, because if prices are going up, but your investments are going down, where are you going to get that money? Well, hopefully you have enough solid income, secure income from pensions, income from Social Security. That does go up based on inflation, sort of. You might have a pension that does. Very few pensions actually increase. Annuities typically don't increase. But to save the retiree, the typical retiree, as they age, they spend a little bit less. So they're going to already have kind of an automatic inflation hedge just because they're going to do more of their fun stuff early on than later on. Typically, people aren't traveling, riding around the world in 80 days. When they're 80, they did that in their 60s or 70s, more in the go-go years. So most of the expenses are up front. If you could live reasonably comfortable with a buffer, in your 60s, as you get older in your 70s and 80s, if there is inflation, it's probably not going to impact you as bad as it would if you were just living hand to mouth from the day you retire. So again, preparing for retirement is really important. You need a buffer. You need a slush fund. You need the extra money. You need to save what you're not spending. Don't just spend it because you have it, because inflation will eat it up down the road, and it will continue to eat it up once it's set in. Like you said, even though it's eased, has it really eased? No, it really hasn't eased. It might not be growing as fast as they thought it was at one time, but it's still growing and it's still accumulating.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management. We're talking about current events here. Our phone number, 520-780-9059. If you have questions or comments, or you'd like to get in and sit down and talk with Jeff on a one-on-one basis about your individual journey towards a confident retirement, Call 520-780-9059. We would love to talk to you. Jeff, let's talk a little bit more about what's going on with the market right now. Memory stocks are coming back down and SpaceX is down a little bit. Is it time to buy SpaceX just yet?
I don't think so. I had a lot of clients before SpaceX went public. They were just, Jeff, are you going to get us in? Are you going to get us in? I said, first of all, it's hard for somebody who's not friends with Elon Musk to get any anyway. My son has a Robinhood account. He got one share, even though he invests quite a bit with them. So whoopee-doo, he got one share at $135, wrote it up to 200. He couldn't sell it till it was down to 120, so he lost $15, even though he got IPO. Now, I told everybody on a BombBomb video, so if any of my clients are listening, they probably know they got it. If not, look in your emails, you'll find it. About a week before SpaceX, maybe 2-3 weeks before SpaceX actually IPO'd, I said, this is how IPOs really work. They get hyped, overhyped. Everybody wants them. And as soon as it hits the market, it goes crazy and it goes up. And then what happens is the people that want to take profits start taking profits and it goes down and everybody says, oh, wait a minute. SpaceX isn't even profitable. Have we even looked at the fundamentals? No. Oh my gosh, this shouldn't be a $150 stock or a $200 stock. Maybe it should only be a $100 stock or maybe even an $80 or $50 stock. And considering we only have a small number of the total shares are even out there in the float that are actually out there being able to trade. So there is scarcity, which is why the stock can be so volatile. It doesn't take a lot of sells to make it go down, doesn't take a lot of buys to make it go up. But as we go through time, each different level of investor has a chance to sell and take profits. Now, some of these early investors got SpaceX stocks at 10 and 15, $20 a share compared to today's price and would make 4 or 5 times their money, even selling it at $100. So they might still sell when their stock, which is restricted, becomes unrestricted. And that's going to happen over the next year with just about every share that's out there. So if you don't see how this actually works, you could get stung in the down swoop. And we're looking at just in the last month alone, SpaceX is down 25%. We've got Micron is down about 35% from its high just a month or so ago. A memory stock, they're overvaluing and overpricing their chips based on demand or shortages of demand, but you've got all these other companies coming into the market are going to create some competition based on the increased supply. There's a lot of hype saying, oh, it doesn't matter. People are going to be paying twice as much for a data center. They're going to be paying maybe even $1 trillion to get a data center built, and companies are willing to pay it. Well, that's just some company trying to hype you into buying the stock so they can continue to overcharge for their chips, in my opinion. So I think SpaceX, I wouldn't even consider it probably till it was down around probably at least under 100, maybe 80. But when you buy SpaceX, it's going to be a long-term hold. It's not going to be really a good trade. Right now, it's a good short sale. If you want to just do a little bit of trading in your own personal account, it's up a couple points here and there every other day, but the trend is definitely down. If you look at from its actual high of $213 and being down at 116, it's down almost 50% from its high. So that's a pretty significant drop, in my humble opinion. So if you're my client, aren't you glad we didn't jump into SpaceX and buy it at 165 or 170, thinking that this thing was going to go to 400, and then all of a sudden, have it go up to 200, and then have it go back down? I guess we could have tried to buy it at 165. It was only about a week to get to 200, and then it was down from there. So you just never know when the market's going to flip on a stock, and it did it pretty quickly with SpaceX. Now, there's other things that were overly hyped, and I mentioned like Micron. Micron's down 22% in the last month. But if you look at its high being at over $1,200 a share, and this week it was trading in the low 800s last time I checked. So, what are you looking at? That's 35% roughly that it's down from its all-time high. Now, if you would have bought it a year ago, sure, you'd still be up 2 or 3 times your money. Is that good? Heck yeah, it's good. So if you would have bought, it would have been a great thing. But for about 5 or 6 years prior to that, it was relatively flat, around or under $100 a share. Now it's at 800. Is it time to take profits? I'd say heck yeah. That's what we're seeing in the market. And we're seeing smart money taking profits, and that's what's driving it down. But we're seeing a lot of people that decided to jump on board when it was $900, and now it's in the 800s, and they're going like, well, I got to wait till it gets back to at least 900 before I sell. Well, I'll tell you what, based on what I'm seeing in the market, that stock could probably easily sell for $200 or $300 a share before it gets back to 900 or 1,000. Now, I could be wrong. There could be some little dead cat bear market bounces, but I think we're entering kind of a cyclical bear market because we've just really overdone it on the tech and the AI. If they can blow smoke up our dresses and make us think something is really not there that is there, or something that is there that isn't there, you might get a lot of Main Street investors investing. But what I have seen lately that I haven't seen, and which also hurts our trading, is because we know that institutions typically, if there's a bull trend in a stock or a bull trend in an index or the market, if there is a dip, you'll see an increase in volume from institutions, but we're not seeing an increase in volume when the dips are being bought. We're seing very low volumes, and we're seeing just a few Main Street investors. Basically, the dumb money's participating in the bounces or in the dips, but the dips seem to get lower and lower each time, which means the institutions are smart to get out of the market and basically sell it to people buying the dips. They're selling on the bounces. So it seems like institutions, what I'm observing is institutions definitely are playing more against us now than they have in a long time. And that's usually what happens previous to some really rocky times. And yeah, the market hasn't been easy to navigate. Every time the market goes up, but 3/4 of the market goes down. And it's only one little sector that might have unknown stocks that haven't done anything for years that all of a sudden get all these buys because institutions or algorithms or robots are buying certain stocks, which actually prop up and make the index look okay. But if you're looking at the Mag 7, flat or down, that's a Magnificent 7 that drove the market last year. It's just really not made any money. You're seeing a couple of bright spots in the Mag 7, maybe like Apple, but I mean, Tesla's getting hammered. Netflix has gotten killed, all down 20, 30%. Meta hasn't done anything for over a year. Google had a little run. It looks soft now. Amazon's not doing well. Microsoft is down 20+% just in the chart I just looked at, just the recent past. So we've got a lot of things that were overhyped, overplayed. And if you were in those things that made a ton of money and you were living high on the hog thinking life is good because we're making so much money, it's never going to end, you could be down 20 or 30 or 40% just in the last few months if you're in those high flyer stocks that are now selling off. So be careful. If you want to just ride the market out, that's fine. But eventually when those stocks that drive the market get sold off at the extent that I'm seeing them sell off, if margin calls start happening to the extent where people have to sell extra stock in order to cover their margins, as I explained before, if you look at institutions not willing to buy until the market gets down far enough below where it is now that they're willing to buy in again, looking at guys like Warren Buffett, 40% of his Berkshire Hathaway is in cash, waiting for it to go down to sensible levels. He says never in his life has there been so much gambling in the market as he's seeing people gambling right now. Fundamentals have no merit. It's only gambles. He says, how can you be an investor when you're investing against gamblers? And when you see stocks go up 5, 10, and 20% in a day or down 5, 10, and 20 in a day, that's just unreal compared to what I've experienced the last 40 years in the stock market. It's not just one stock. It's like a whole bunch of stocks. You get 18 or 20 stocks in a day that just go up 20%. How in the world did that stock just get worth 20% more than it was a day ago? That just doesn't make any sense to me. But that's the hype that we're seeing. We're seeing some of the energy stocks. I won't name one, but one that went from, I was buying it a couple of years ago for $30. It was over $300, and now it's down to $120 again. And I remember talking to somebody that was actually inquiring with us to manage their money because they had a very large position in this one particular company worth several $1 million because they were an insider in the company, and they weren't going to sell until their portfolios were $10 million. Well, guess what? Their portfolio maxed out about $6 million, and now it's down to about $1.2 million already. So did they sit on the sidelines and just give up $4 million because they didn't take profit? I think that's what's happening is the greed is going to kill a lot of investors. There are going to be a lot of people very upset that the market didn't continue to go up when it was hyped up. And everybody was told a story that it was going to go to the moon. And so all the Main Street investors propped up the institutions and the Wall Street firms that were saying that. They took profits. And now the normal person who's not sophisticated investor doesn't have that much money, shouldn't be losing half of their portfolio when they could have locked it in. Unfortunately, they're the ones that are going to get hurt, and the rich keep getting richer. Wall Street keeps making money on every bit of bad news that's out there. Unfortunately, too many of us normal middle class, out there worker class people that actually create jobs, create income, create economy are the ones that are going to get left holding the bag, where the bankers and the puppeteers, so to speak, are manipulating the market and taking advantage. So be careful. That's why we use about a 5-prong approach. It's not just about the investments you make, and it's not just about swinging for the fences and shooting to the moon on every good investment. It's take advantage of that with the amount of money you can afford to risk or lose and solidify an income plan. Make sure it's tax friendly. Make sure that you have something that will support you if you ever need a nursing home, or if you ever need to have a big expense where it doesn't cause you a tax, where you have to take tons of money out of an IRA. So you have a Roth or a LIRP or someplace where you can get tax-free cash. You have the income that'll pay all your bills. That way, a market crash or correction, if you do get stung by it or hung up in it, it's not with all your money. Like this one person that had every bit of stock, it's down almost 2/3 of where it was. So they've got 1/3 of the money they could have had if they'd have just sold out like 4 months ago. Let's not be stupid. Let's not be greedy. If you've gathered a great nest egg and you can live on it and make a plan where you can set a half of it or maybe 2/3 of it aside to create a never-ending income that'll pay all your bills as long as you live, even with a buffer for inflation, and have some extra money so that the peace of mind is there if the market does correct. You're not doing it on all your money. You're only doing it on a portion of your money. And that's really our approach. And it will come out as the hero of the day when the market corrects. But honestly, there are some people say, gosh, my friend's making more money than I do because all his money's in the market the last couple of years. Well, that's fine. But when the market corrects, you're not going to lose yours. So decide what camp you want to be in. If you don't have a job, you don't have a way to replace that income, I would kind of take advice from companies or people that advise you on protection and income and tax favorable strategies where you keep more of your money and don't lose it when things that you can't control happen, because the things that you can't control do happen. They will happen. They have happened through history. And just because they haven't happened yet since you've been retired doesn't mean that you're not going to have a couple of major corrections and crashes between now and the time that you end up passing away and may need that money the duration. So unless you have a rich uncle or somebody's going to die and leave you a bunch to make up the difference, or you can go back and get your job back, which you probably can if you're in your 70s or 80s, then you need to take a look at what's happening and realize that this market's getting a little bit out of whack, and you need to just step back, take a look at it, and protect what you worked for.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management. Once again, our number 520-780-9059. Jeff, with tech and memory stocks pulling back sharply, is this a healthy market correction to buy the dip, or just the beginning of a larger structural shift away from AI growth?
Well, buying the dip, you buy the dip when you're in an uptrend. You don't buy the dip when you're in a downtrend. When a stock turns over, makes a new high, and then as it goes down, it tries to return to its original high, stops short, and goes down again and makes a new low. And then it tries to make another new high, but it stops short of the last high. And then it does that 3 or 4 times. I'll call one out. You can look at the chart. Micron is right there. Look at the last month of Micron. There's 3 lower highs and 3 lower lows, and we're right there right now. And it got hammered this week. So that's one of the biggest, probably the stock that led the market for the last probably 6 months through June, and then actually through about May, and it hasn't done anything since then. So yeah, you got another one, a memory stock. SanDisk was another big one that took off. I'll just pick up that chart right now and just see what that one looks like. That was, down 42% in a month. I mean, what the heck? 42% in a month, and it's actually gone down more than that. Just this last week, it went down over 30%. For the last 3 months, it's flat. It's pretty much even. But that means for the 3 months when it almost doubled in price, we've given it back now. So is it a healthy correction? I'll look at the chart right there, and all I see is lower lows, lower highs, and the trend is still down. So any dip that you think you want to buy, and that's what Wall Street and what Kramer and everybody on the talking heads on TV say, is, oh, it's a dip, buy the dips, buy the dips. Well, if you keep buying the dips all the way down, you keep buying, and you keep buying lower and lower, lower, so that it allows the pension funds and the institutions and the smart money to keep getting out and sell the bounce instead of buying the dip. So they tell you to buy the dip so they can sell the bounce. And that's what really happens with smart money. And that happens all day. So you have to look at the overall trend. When that overall trend, when you've got a lower high and a lower low and another lower high, you've turned into a bear market, period. So 1, 2, 3, 4, I got 4 lower highs and 1, 2, 3, 4, 5 lower lows on SanDisk. I'm just naming some names of some of the stocks. Now, is there still a market for SanDisk? If they hit their future earnings estimates, could it go back up? Sure, it could, but the trend is not in a place where I want to be in that kind of a stock right now. I mean, if memory stocks are selling off 30 and 40%, and they were the only thing driving the market, what's propping the rest of the market up? Well, all the smart money that's getting out of SanDisk are buying, look at Target, look at some of the retail or the consumer staples type stuff. They're going into where the safe money hides when the tech sell-off happens. And that's what we're noticing right now. That doesn't necessarily mean those stocks are rallying big time, but at least it seems like it's a safe haven where smart money is exiting those high flyers. They took their profits and they're kind of hoping that we're dumb enough to keep on buying their stock every time they make it pop. And by the way, the market makers can do that by setting prices in the morning to make it look like it's going to pop. And then they yell, buy the dip. And then they'll raise the price because they'll set the bid price. And then you'll get a whole bunch of suckers come in. Year in and year out, even when the market's good, the average investor, 80% of the average investors lose money that are doing it themselves, day trading and trying to invest, typically emotionally, not with any fundamental background, or even looking at the true trends in the market and the momentum. So yeah, to answer your question, there are some sectors of the market that are in significant downtrends and you ought to stay away for a while. There are some that are still kind of flirting with, maybe the healthcare industry is one of them, energy from time to time. Financial's not doing too bad lately. But again, they're all so vulnerable, man. Unless you have money you can afford to lose, I wouldn't go into any of them. But for the money that, you can afford to take risk on or wait on, you don't need for your daily investments, there is a place that looks stronger than what was strong a month ago. So the market's changing so fast. It used to be you could buy tech and hold it for 2 years. Now you buy tech, you hold it for 6 months, take profits and hope you don't lose it all by holding it another 3 months. It's a roller coaster ride. Managing money is difficult as it is, but in the markets like it is now, good luck. It's tough. We have a lot of data that help us, but most people don't have that data to keep out of harm's way and end up getting hammered when the market corrects.
Good conversation, Jeff. If you'd like to know whether your retirement strategy is truly built to withstand whatever the future brings, right now's the time to find out. Schedule your complimentary retirement roadmap with Jeff Vogan here at Premier Retirement. He'll show you where you stand today, identify potential risks, and help you build a strategy designed for long-term confidence. So call us at 520-780-9059. It's 520-780-9059. Or you can visit us online at primret.com. Your retirement deserves more than hope. It deserves a written plan. Jeff, time for a break. When we come back here on Premier Retirement, we've got listener questions, and later on, the 5% diversification rule, why one stock shouldn't make or break your retirement. When our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shade.
Happy August 1st. You're listening to Premier Retirement with Jeff Vogan. My name's Jeff Shade. We're here for you on the radio each and every weekend for your fiscal fitness and your financial education. If you've missed any part of the program today, remember we're a podcast. Go to where you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a prosperous and confident retirement. We're on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also on Sundays at 11 a.m. Our phone number, 520-780-9059. If you have questions that you'd like to ask Jeff and you'd like to get in and have your individual Premier Retirement Roadmap, no cost, no obligation. Again, that phone number, 520-780-9059. Okay, Jeff, time for listener questions. Timothy is in Saddlebrook Ranch, and Timothy says, I'm 60, my wife is 62. I'd like to retire at the end of the year. We're test driving what it's like to live on our projected retirement income. We have about a $500,000 balance on a fixed rate mortgage for our home at 2.99%. But if we had no mortgage payment, our projected income would be comfortable. But it's a little tight with our mortgage payment on a monthly basis. So my question is there a mechanism to pay off the mortgage with tax-deferred retirement funds without making all of the funds taxable income?
No, there is not. Simply put, you have to pay off a house with after-tax income. It just can't be done. Unless you have a LIRP, life insurance retirement plan, and I'm guessing you don't, or you would have already kind of known this strategy. But even if I had a LIRP, or even if I had a Roth IRA that I'd already paid taxes on, I wouldn't take the money out to pay 2.99 when I could make 4 or 5% on my money. Just to give you an example, I'll give you 2 examples of why I think this would be just absolutely foolish. The $500,000 that you would take out of, let's say, assuming you're taking it out of an IRA because you just asked that question, can taxable funds be non-taxable if it's a deferred account? If it's a deferred account, then you've not paid taxes on any of it. $500,000 plus the $100,000 you're probably already making if you're kind of nip and tuck and tight. I'm guessing maybe your income's around 100, maybe 120 minus taxes and stuff. I would probably give a reasonable income to live on, maybe. So let's just say you need to pay off the $500,000. Well, in order to do that, over and above what you're making out of a deferred account, you'd have to pull out about $720,000 because you'd be in more than a 30% average tax bracket, pulling out $800 or having $800 gross income. So that $500,000, you'd have to pull out about $120,000 to make that work. And $220 right off the top would go to the IRS. You'd never see that money again. If you need it for emergencies, you don't have that. That $220,000 can pay that mortgage payment, I'm guessing, probably for a good 10 or 15 years. What's your payment? $3,500 a month, maybe, probably $5,000 if you financed it on a 15-year mortgage. 2.99 sounds like a 30-year mortgage, so maybe you're paying $3,500 or so a month. What if you, and if you pay that off, you have $3,500 a month. What if you took that $720,000 and put it into an income-producing asset, or let's just say you pulled out 6 years of $120,000 and paid 20% taxes, you'd have $600,000 in an after-tax account, either a Roth IRA or a LIRP, life insurance version of a Roth IRA, where you could get about $40,000 or $50,000 of tax-free income for the rest of your life. I would rather see you do that and live a little bit tight for a little while. Or you take that $500,000 or the $720,000 that you would have taken out of the IRA. Let's just say you have $1 million in 401k account. So let's say you took $700,000 of it that you wanted to set up for guaranteed income that would cover your mortgage and then some. So let's say you take $700,000 at your age, you'd have approximately $45,000 to $50,000 a year that you could pull out of that account for life. And that would be a joint life income payment. Okay, so you pay tax on the $40,000 a year, but if you're at, in the 12% bracket, and I'm assuming you're going to live on some of that deferred income to get you up to that 100 or 120, but then you stabilize and steady the income, you steady your tax bracket in the 12 range, maybe a little bit at 22, and you pay about half as much in taxes as you would on that same money, but you're able to cash flow it and still have more money left over. If you did the Wall Street version of an income plan, which is a 4% rule, which has already been debunked, it's more like 3% rule if you talk to any accounting firm that's actually done an audit on it. So let's say you could take 4% just to say the Wall Street somehow is right this time. 4% on that $700,000, about $28,000, about maybe less than $2,500 a month in income might not be enough to even cover your mortgage. So I see why you might want to just pay it off. The difference is you don't have the liquidity. If you ever needed to grab money from your house and you weren't healthy or able to get a mortgage, you couldn't just turn that equity in your house into cash. Whereas even in an IRA, even if it's taxable when it comes out, other than maybe tax deductions for healthcare or other things that might be emergencies that you could write off, that asset is still yours. You still have your home, you still have your home equity, and you still have access to $500,000, $600,000, or $700,000 in cash, and hopefully more than that. So we would build a structured plan where your cash flow would be guaranteed to more than cover the mortgage on a tax efficient basis, but we would not suggest that you lop off $200,000 in your hard-earned savings just to pay the IRS so you can get out of a house payment.
Bill, good question. Thanks for listening to us in Saddlebrook Ranch. And again, if you'd like to further the conversation with Jeff, call 520-780-9059. No cost and no obligation for that. Okay, Jeff, next question is Bill in Ventana Canyon. Bill says, I'm 62 with about $1 million in a traditional IRA, $700,000 in a taxable brokerage account, and $150,000 in a Roth IRA. My pension and Social Security covers my living expenses, so I'll likely leave a sizable inheritance. As I begin Roth conversions, should I spend down my traditional IRA first and preserve the taxable account for my heirs since it receives a step-up in basis, while inherited IRAs are fully taxable and subject to RMD rules?
Well, the first thing that just jumped out at me is that whole question regarding the brokerage account that gets a step-up in basis only gets a step-up if you never sell or buy or trade anything. Now, if you're in mutual funds, you're probably getting a tax bill every year for that. So you're getting a step up in basis on that. You're paying taxes as you go for your heirs. Now, if you have just Apple stock or something like that, you bought it $100,000 and now it's worth $700,000 and you just want to keep that in there, then yeah, they get a step up in basis, and that is a meaningful step up in basis. And I probably wouldn't sell that stock, maybe a little bit to live on if you wanted to pay the 15 or 20% tax on it as a capital gain as you needed the money. But even capital gains on that taxable brokerage account is still more tax friendly to you, maybe than even doing a Roth conversion, depending on how many heirs you have. I mean, if you have $1 million, you might not even find you need to do a Roth, depending on what your other income is. If your pension and Social Security cover your living expenses, you could have a really large pension and not eat it, or you just are super frugal and have no bills, and that's why you've been able to save a lot. So I don't know the numbers, but Roth conversions, I would do that only to maximize your 12% tax bracket. I'm assuming you're probably living within that bracket. I don't know if you're single or married, but if you're married, you've got a little bit more room for that bracket. If you're not, then it's going to be 22%. And I'm not sure it's going to necessarily be better for you to spend that down, faster to do Roth conversions, or just little by little. You're 62, so you've still got 12 or 13 years before you need to worry about taking those required minimum distributions. At your age, you get to wait to age 75 under current rules. So you got a long ways before you have to take that money out. The thing is there's going to be a lot of growth. So if you'd rather grow it in a Roth IRA so you help your heirs out and not leave them a big taxable inheritance, which is what it looks like you're going to do, then that makes sense. Another thing you might want to consider is with that, if it is just mutual funds and things that give you the surprise tax bill on that brokerage account, because you never know what you're going to take profits on or how they're going to rebalance, if it's a managed account or if you're just doing some trading on your own, you never really know what your taxes are going to be unless you're really paying attention to every trade or change that you make. But if somebody else is managing it, they're not looking at your tax situation every day. They would rather, in fact, if I'm managing money and doing a lot of trades or balancing and looking at different opportunities, I'd rather do that in an IRA where every transaction is not a potentially harmful tax situation. I would rather put your taxable brokerage account into something that's never taxable, like the rich man's Roth, which I've talked about a lot of, very much is about the LIRP. If you put that $700,000 in a taxable brokerage account in a LIRP, by the time you funded it, it would still be worth $700,000 or more. And it would be available to you tax-free, and the growth would all be tax-free. And if you died, between what you take out and your heirs, it's probably going to be 2 or 3 times that $700,000, but you never pay tax. You never pay a dime of tax on the growth. That might be even more efficient than doing a Roth conversion. And when we do a tax plan, we look at both options. Generally speaking, we do a little bit of both because some of that IRA, you've got $1 million in traditional IRAs, that's non-taxable. You've only got 150 in a Roth. Maybe you need a little bit more. But if you could have an account that was worth, let's say $700, $800, or $1 million that you could tap into any time and it would never cost you a tax, you'd never have to sell a stock and pay a tax on it in order to have $100 or $200, $300,000, you should consider being your own bank. There's a book called Infinite Banking that realtors, a lot of these fix and flippers and investors use, where they put a bunch of money into LIRPs, life insurance retirement plans, so they have a tax-free bank. And when they borrow money to buy a house or to flip a house or to improve a house or to pay off a rental, they borrow from their self, and the money they borrow pays off the loan or pays off the house or pays off the investment. But the money, because it's a loan, the money's still in that account growing on average about somewhere between 5 and 10% if you look at historical returns, tax-free. And if you get hit by a bus, it's worth probably double what your balance is, and your heirs will never have to worry about paying tax. You don't have to worry about a step up. You get hit by a truck next week, you double your money, and there is no worry about the step up. So that's another option to combine with your Roth conversions if you want to look at a more robust plan. I don't know but anybody in this town, in fact, I don't even know anybody that I've met that does as thorough of a job from the standpoint of comprehensive planning that we do. And there's a few firms like us that dabble in the tax planning world, and most of them kind of disown, they just want to manage money for a fee and disown the idea that there are other accounts that are tax efficient, that are safe, principal protected, that provide income, pay less taxes, and leave more money to your heirs if you use all the tools. It takes a little while to get the plan together. That's why a lot of people don't like to use it. But our bills are paid whether you come aboard or not. So in other words, we're not like hurrying to close deals anymore. We're just helping people build plans. If it takes 3 or 4 visits or 2 or 3 months to figure out what's best for you, will take that much time. But if you see our plans, you might find out that a week or two of looking over the numbers might convince you that we have a technique that works, and the people that come here stay here for a reason because they like saving taxes, they like guaranteed income, and they like leaving their heirs a nest egg that doesn't create a tax problem for them.
Bill, we appreciate you listening to us in Ventana Canyon. And once again, if you'd like to continue this conversation with Jeff, it's 520-780-9059. It's not going to cost you anything. Totally complimentary. Also online at primrat.com. But Bill, once again, call us at 520-780-9059. Get in and sit down and talk with Jeff. Okay, Jeff, next question is Rita in Casa Adobes. And Rita says, I'm 50 years old, a divorced single mom who's getting married this October after a 10-year engagement. My fiance and I are both financially stable, plan to keep most of our finances separate while sharing household expenses, and want our own children to inherit our individual assets. We'll also be selling our homes and buying one together. What advice do you have to help us make smart financial and estate planning decisions as we combine our lives?
Well, after 10 years, good for you for tying the knot. I'm not sure it's going to help you financially. It's a lot easier to keep things separate if you kept it the way it goes. But here's the deal with that. You can continue to keep all your property sold and separate as long as you don't commingle it. Sounds to me like you'll probably commingle a bank account and maybe commingle a house. That house can actually have a beneficiary deed. My suggestion would be each of you do a trust, have the beneficiary of all your stuff and the owner of all your stuff be the trust. Own children are the beneficiaries in each of your trusts. If you never combine those assets and they stay in your trust and you're the only successor trustee, and if something happens to you, one of your children becomes a successor trustee, not your husband because he's got his own money, then it's a pretty clean deal. The deal would probably be your house. Now, you could put the house as joint tenants with 2 trusts as the owners so that there's rights of survivorship, or you could do tenants in common, which is smarter because each trust would own a half of the house and the other person could not arbitrarily do anything with that half without, let's say, your son or somebody in your family that is the successor trustee on your behalf that would own that. Now, what would you do to protect the house for each other would be put a life estate in your trust, which means if one of you dies, the other one has the right to continue to keep the house until they either die or until they sell it. If they sell it, then the proceeds need to be split 50-50 and that person can move on. But if they keep it till they are deceased, then the tenants in common ownership would make sure that the escrow, the title company, would divide the proceeds into 2 halves and give each trust a half, and then your trustee would divide it at that point. So the only cumbersome problem with that is that the trust would have to kind of stay open, have a tax ID number, possibly file taxes if there's other assets in that trust, but it would have to stay open, not dissolved, until that house finally sold and the final proceeds were eventually put into the survivor's trust. But that's how I would do it. I'm not a lawyer, but I'm a certified estate planner. I help my clients tell their lawyers how to do their trusts quite often. A lot of lawyers aren't really focused on that. They do other things, but most lawyers are able to help you. I'm not sure if they would give you the same advice, but from a financially sound perspective, having done this for 40 years and seen many of my clients pass away, many of my clients remarry, many of my clients divorce, many of my clients die after the other spouse, that would be the way I would set it up based on my experience.
Rita, thanks for listening to us in Casa Adobes. And once again, if you'd like to further the conversation with Jeff, call 520-780-9059. We appreciate you listening to us and have a happy marriage. Jeff, let's continue our conversation right now by reminding folks that if you would like your Premier Retirement Roadmap, absolutely no cost and no obligation. It's just a casual conversation with Jeff to talk about your journey towards, hopefully, a confident retirement. We're offering it no cost, no obligation. And to get yours, 520-780-9059. You can make that call today if you want. Leave your name and number. Shelley will call you back during the week and set up that appointment for you. Once again, that number, 520-780-9059. Jeff, let's continue the show today by talking about the 5% diversification rule, why one stock shouldn't make or break your retirement. So what exactly is the 5% diversification rule?
Well, that's just one rule of many. You could have a 10% diversification rule or a 30% diversification rule. I don't think having 20 or 30% in any one given stock is wise. I mentioned earlier about the person that worked at an energy company and 95% of their assets were in their own company stock, and they think it's going to the moon and they'll never sell it until it does. They've been up to a point where they could have retired happily if they'd have just sold out a few months ago, and now they're kind of probably on that wire of where they're balancing whether they can retire or not. If it doesn't come back, they're up a creek. You know, I had clients back in the Enron days. I remember I met a lady. I had an office in Yuma way back in the day, and there was a lady down there who had moved from Southern California. Her husband had worked for Enron, and Enron was starting to have some kind of questionable situations, and she had all of her money. It was about $350,000 30 or 40 years ago. That was a lot of money. But that was all that he had left there in company stock. And he said, honey, this stock's great. You know, it's going to take care of you for the rest of your life. Never sell it. And that was his dying wish. So she decided never to sell it. And I said, well, that's all your eggs are in one basket. Are you sure you don't want to at least put half of it somewhere else, like in an annuity that'll pay you $2,000 a month and at least cover your rent or your gas and utilities or something? And she goes, no, this will take care of me. It's been taking care of me just fine. It's holding its own. It's actually worth a little bit more than when he died. So it's good. Well, you know, over the next year or two, we found out that Enron was kind of a scam. They were pulling the parts together, reselling them and overvaluing them and doing some really creative accounting that made the sum of the parts were so much more valuable than the whole. And in reality, the sum of the parts weren't any value at all, and it crushed. They got crushed. So she was crushed. I remember going back to look for her when I was back down there, and I wanted to just see how she was doing. And I saw her house for sale. And her neighbor said that she had moved back in with her kids in California. So that's retirement failure, putting all your eggs in one basket, even if it looks like the best company ever. I told you the story about Norm 100 times. He worked for a big chip company up in Phoenix area, and it was Intel, and he had a ton of stock and a lot of other stocks, but the majority of that was Intel, and he kind of had a sentimental value, and his broker said, never sell it. It's always going to be good, blah, 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 blah. The stock market average X, and the market crashed, and Intel crashed, and all the other stocks he owned crashed, and he ran out of money. The next 8 or 10 years, he had to get jobs to supplement his income. He had to take Social Security early, and he was almost out of money when he came and saw me 9 years after that whole debacle started in the year 2000. So having a lot of money, I've seen it firsthand, how having a lot of money in one asset can be devastating. Granted, you may never be broke like an Enron situation, but why not take some profits along the way? One of the things that we do when we manage portfolios, and we have like 4 different risk categories in our managed portfolio. Now, some of the risk categories, like the super safe money portfolio, because it's like an ETF with 1 million short-term bonds in it, we might have 50% in that one, but it's basically a money market. So aside from that, but if we're buying individual stocks, if we're buying like an ETF, an exchange traded fund, and it's energy ETF, we know that it has probably 40 different positions. So you're buying 40 different stocks. I mean, if we did 10% or 15% in that, we're still diversified because not any one stock makes up probably more than 1 or 2% of that ETF portfolio. So keep in mind the diversification. That's why people buy mutual funds. But if you're doing individual stocks, I would not say buy Intel and Micron and Google and Apple and all that kind of stuff and have it be your entire portfolio. Now, I've met some people that bought Apple early and are worth millions and millions of dollars, and that's basically all of their estate. They're trying to figure out how to sell without, pay the capital gains taxes on it efficiently. But bottom line is they made so much money, even after tax, they're still rich. I would diversify, but some people are just hell-bent on riding it out. Apple might be one of those that if you've turned $300,000 or $400,000 into $3 or $4 million, you're probably fairly safe on for the time being. But why not diversify into the Googles and the Metas and some of the other Magnificent Seven that go up when Apple was flat most of last year, and now it's doing better again. But there's other stocks that make money when yours aren't. So diversification is really smart. Anyway, in our portfolios where we have individual positions, we try not to go more than 5% in any given position. But again, people have parts of typically 3 or 4 different risk categories of portfolio. So even if we went 6 or 7% in one stock, in one portfolio, it might only be 2 or 3% of the person's holdings. We feel a lot more comfortable with that because if one company has earnings and all of a sudden earnings disappoint and that stock goes down 20%, if you have 10% in that stock, your whole portfolio goes down 2%. If you have 5% in that stock, that particular portfolio goes down 1%. I mean, that's a big difference, 1 and 2%. What if you had 50 or 60% of your money in that stock? Let's say 50% in that stock, and the stock sold off, went down 20%. Well, you just took a 10% hit in the market that day, just on one position. And that might, if you're not emotionally okay with that, that might create a little bit of a panic, maybe a sell-off. But then again, it may be smart to sell. It might be the start of a bear market for that particular stock. Bottom line is, you should not have all your eggs in one basket. We don't have all our eggs in one basket when it comes to the stock market in general anyway. For example, even though we use on our managed portfolios a 5% rule, roughly, give or take, the 5%-ish rule in any one position, it never really is in a single stock. But we don't even use just the stock market as a single position. Some people say, well, yeah, but it's diversified. I've got a stock. Well, there's times when 90% of the stocks are going to go down and you don't have a floor on that kind of thing. So we use diversification from, you should have money in the market that you can afford to lose and risk it according to what your gut tells you and what your risk tolerance is. Have some money in principal protected accounts that you can guarantee income from, and have yourself in a tax savings place where you can grab assets, but it never costs you taxes when you use the money or when you hand it off. So when it comes to diversification, and by the way, then we also categorize it between deferred and Roth or after-tax assets as well. So there's probably 5 combinations of diversification we use just in asset allocation, as opposed to just what asset we have in the allocation. So again, diversification is, I think, what keeps our portfolio stable, gives our clients confidence, definitely gives me confidence as a financial advisor to know that we're not betting on any one position or any one angle in the market that we can't control, that surprises us every chance it gets, does what it wants when it wants to, not when we think it will. If you're building your retirement portfolio, retirement sanity on what you cannot control on a hold and hope model, then you're just setting yourself up for failure, setting yourself up for disappointment, setting yourself up for high stress and early strokes. I mean, stress kills you. So why put yourself in that position where you're stressing out about money on a daily basis, especially when we get to times like we're in now, when there's no rhyme or reason to why the market goes up or down any given day. They try to make it look like there's a reason, but it's really just manipulation and sales and algorithms and all kinds of things that are working against the public right now. So depending on how much you want to play that game and how much stress you want to have in your life, it's up to you. We try to de-stress our clients, but the last thing I want them to do is come in and say, hey, Jeff, I want you to risk all my money. It's okay if you put it all in one thing. I actually had a client last week that came in and said, well, what if we don't want safe stuff? Everybody we've talked to says we're okay because we've got $2 million in savings. Are we going to be okay? And I said, well, for your own safety, I'm a fiduciary. You need some principal protection if this is really the income level you want, because you can't guarantee it out of that. Well, how come other people say we can? Because all they do is sell risky stuff. That's all they do is portfolio manage. All they do is fee-based stuff. Well, we do other things. And for my own sanity, I want my clients to be happy. I want them to weather the storms. I want them not to be caught blindsided by the next market crash. And by the way, half these people that this particular couple I was talking with, I know haven't been in business probably even since a big market crash. They're a lot younger than I am. It's a newer company and haven't been around. They haven't seen their clients go through crashes yet. And it's going to be a rude awakening for them, especially having just retired. And if they do end up moving their money to one of these other firms, they're going to probably be surprised at least a few times over the next few decades because they're fairly young. I told them that I would not be their advisor if they insisted that they would not have safe money or guaranteed income, but they wanted a guaranteed set minimum income level. I said, you can't do that without some guarantees, and I won't do it because I don't want you to put me through that stress either. So that's kind of a win-win for us. I think if you're going to want to de-stress your life, I can help you, but don't add stress to mine, right? I still want to wake up in the morning confident that your retirement plan's okay as well.
Talking about the 5% diversification rule with Jeff Vogan here at Premier Retirement Planning and Wealth Management in Tucson and Mesa. Once again, if our conversation piques your interest, 520-780-9059 is our telephone number. One of the biggest mistakes that retirees make isn't necessarily picking the wrong investment. It's owning too much of the right investment. So if your portfolio has grown over the years, you might be carrying far more risk than you realize. And of course, Jeff here and the team at Premier Retirement offering this complimentary retirement roadmap designed to help uncover concentration risk, evaluate your diversification, and determine whether your investment strategy truly supports your retirement goals. So again, our phone number 520-780-9059 to schedule your no-obligation visit. It's 520-780-9059. Or as always, you can visit us online at primret.com. Jeff, out of time for this week. Thanks so much for your time. But as I do every week, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Vogan, I'm Jeff Shade, wishing you a great beginning of August weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.